And there we are. Let's watch people drop in here. There we go.
Okay, we're live. Awesome. Wait, is this considered the August webinar or is this still July?
This is July, so this is number 7 of this year's monthly webinar
Great.
series. So, hello, Tavia. Hello, Lauren. Hello, Brennan. We see some familiar names here. Hello, Kendra.
Very good.
Everyone chime in and say hi. Let us know where you're from.
What's up, Adam? Adam Willis jumping in here, trying to see how it's done. It's a property manager friend of mine.
Oh, nice. Welcome, Adam. How are you doing today, Peter?
I'm
Busy?
doing well. Staying hydrated. My big problem in the afternoons is I eat too much for lunch and then I'm like I drag in the afternoon, but
Mm,
I didn't do that today. I had my factor meal and had a little cinnamon treat from Papa John's. That was it. And I don't it was only like
nice.
a little one, so
Nice. Planning ahead to keep your mind clear. I like it.
you got to be high energy.
Oh yeah. Hobby, Columbus, Ohio, Coldwell Banker Realty. Welcome. Good to have some realtor representation here today.
Yeah.
Love that.
Cool. We will jump into it. Do you want me to share? Do I normally share or do you share? I can share.
You normally share, I believe. Yes, you weren't here last month, so
Yeah.
it's been a minute.
Yep. I got it. I got it figured out though. I've run a
All right,
webinar
all
or two
right.
in my day. Okay. Welcome everybody. It's great to have everyone here, and you are at RL Property Management's July client webinar. And today we're going to talking about finding great investment properties. So, just a quick background if you're not familiar with me, I'm the owner of RL Property Management. My background's engineering. I bought my first rental property in 2008, not 2018. Still own it, and my partner and I own a handful of rental properties, as well as an engineering company in addition to RL Property Management. Um, I'm pretty active on the national property management scene. I like to speak at conferences, and I have a newsletter and a podcast, and that's a little bit about me. So, what are you doing here? Well, our mission at RO Property Management is to help property owners be successful with their real estate investments. And a lot of times that means partnering with you to have it professionally managed. In some cases, it doesn't. And in some cases, we refer you to a different solution, whether that's self management or another local property manager who might be a better fit for you. But truly, our goal at RL is we want to see your property well cared for, and we want to see you be successful with it, whether it's a single family home or a portfolio of 50 units or anything in between. And we ran a poll at the beginning of this year of our current clients, our current property owners that we're managing their properties for. And we found out that 2/3 of our clients don't have the knowledge or confidence that they would like to when it comes to real estate investing and rental ownership. And so our mission this year with this webinar series is to change that and to help instill confidence and provide the knowledge to help you be even more successful with your properties. So what we're going to do today is we're just going to look quickly at the scorecard for our company. So we have a public scorecard that kind of shows how we're doing as a professional property management company. Talk about a couple reminders, and then the bulk of today's content is going to be all about investing in rental properties and finding the right rental properties. And this is going to be pretty interactive. Happy to have plenty of Q&A throughout. So feel free to jump into the Q&A or into the chat, pop your questions, and my team will help us get those answered and make sure that either I address it live, or if it's something more specific to your situation, we can follow up afterward. Sound good? Okay. So how is RO Property Management doing for our customers? So here's the latest update as of July. So this is current. We look at median days on market, which is 10. So that's how long it takes us to lease a property. Median time to turn, which is how long it takes us to get a unit ready to rent, also 10 days. Lease renewal rate is at 77%. Our occupancy rate is at 89%. You can see our average rent there just hanging out just below 1,600. Median repair days, that's how long it takes us to address to completion an occupied maintenance request, so just a hair under 6 days. We've got 92% of rent collected by the 5th of the month, so chances are if we're managing your property, we're getting your rent collected on time. And residents are satisfied with our maintenance solutions at a 4.8 out of 5. And you can see kind of changes from the prior month. Average rents are up, days in market and time to turn is down, which is very impressive for this time of year, especially the turns. And everything else is looking great.
I was going to mention that, Peter, for this time of the year, we're in the peak busy season.
Yeah.
And so it's nice to see these numbers moving in a positive direction.
Yeah, the team's been working really hard to get our properties turned over, get your properties turned over, and to market as quickly as possible. We've made massive changes in our operations over the last couple quarters to come through this busy season strong and make sure that we're getting these properties listed uh, now, because every day counts at this time of year as we're starting to get closer and closer to fall. Okay. If you're looking for property management, just a quick shout out for Catherine, who's on our sales team here. We have her phone number and her email there. If you want some help finding your next property, she can introduce you to some local realtors. Maybe we even have some in the chat. And of course, we're happy to give you 1 month free of property management if you refer somebody to us. So if you're a satisfied customer and are looking to save a little on management fees, we can help you out with that. Okay, let's jump into the content. We're going to do a quick poll just to take the temperature here. Which part of the rental property process do you find the most challenging? So we got a couple options here: finding high potential properties, knowing what numbers to run, negotiating with sellers, understanding financing options, figuring out when is the right time to walk away, or something else. So we'll give a couple minutes there to let people get their votes in. This will help me understand where to spend a little extra time as we go through, because these are the topics we're going to be talking about today. And if there's an area where we really want to spend some extra time, we should be able to do that. Get your votes in. Give a few more seconds.
All right. Looks like we're slowing down. I'm going to go ahead and end it. Show the results.
All right. Very interesting. So number one by far is finding properties. How do you find these properties? And looks like number two answer here is knowing what numbers to run. So we'll definitely spend some extra time on these topics. That's good. Looks like everyone's pretty comfortable with the negotiation phase, and then understanding financing options and deciding to walk away are both kind of tied there with 3 votes each.
In the
Okay.
chat, we had someone say finding a good property manager.
Hey, that is a challenge, especially if you're not in Columbus. I can see how that would be hard. Okay. So how do you find these properties? So I want to actually, before we get into the specifics of like locating these properties, I want to talk first about the sort of pre-work that will make the process of actually finding the properties much more straightforward. The first thing you need to understand is how much you have to invest. So, and a lot of people are just like, oh, I have this much to put down. But the reality is the part that gets overlooked is what are the initial expenses associated with these properties. Almost all cases, especially if you find a good deal, there's going to be capital required to get the unit in rent-ready condition. And that could be anything from radon mitigation to, updating kitchen or bathroom, to deep cleaning, light renovations or remodels. Almost in all cases, when a client brings us a property that they tell us is ready to go, it's ready to be marketed and listed for rent, we almost always find that there's items that have been overlooked. And so I think it's really important that as you decide how much you're going to invest, you set aside some of that, not just for the down payment, but also for these initial expenses. So you've got your initial turn costs. You're also going to have a little bit of carrying costs for a few months typically. So when you first close on a property, there's going to be a process of any initial work that needs to be done, and then there's going to be the marketing time frame to get the property leased, and then even once a lease is signed, there's going to be potentially another few weeks before the tenant moves in and you start collecting rent. And so that period of a few months, that's like your carrying costs, and you need to account for that. Make sure you have that money available to pay for the mortgage and the other expenses while the unit is vacant. There's no rent coming in. Okay, so once you're clear on that, you need to select what kind of property you're going to buy. And the reason we're doing some of this work here is if you just if you start looking on the internet or you go to a realtor and you're just like, I want an investment property. Well, I need to buy an investment property. It's like, all right, well, like what, like, what's your budget? What kind of property, where? So the more specific you can be with these things, the more success you're going to find in, the more, in a weird way, more narrowly you define your target or your goal, the easier it is to find and be successful with. If you just say, I need to find a rental property, that just, it's, your mind is going to have a hard time grappling with that. But if instead you say, whether you're saying this to yourself or somebody else, I need to find a duplex in Grandview for less than $450,000. Well, that's something you can work with. That's something your brain can subconsciously start to solve for you. And that's something a realtor can work with you, or you can set up searches online for. So, property type. Are we talking single family, 2 to 4 unit, 5 plus? Those are like the three main categories when it comes to real estate investing. Single family up to 4 unit is going to be one type of financing typically. 5 plus unit is going to be a different type of financing. Normally, you may need put a little bit more down, and the interest rate will be a little bit higher. And so understanding your property type is very important. And then you need to understand your goals. Are you doing this for monthly cash flow? Are you doing this for long-term wealth building and appreciation? Or is this like a forced appreciation play where you're going to buy a distressed property and then renovate it and either hold it or sell it? So those are all very different types of properties and types of approaches, and they're going to be modeled differently, and they're going to even potentially be financed differently. And so understanding what are you trying to achieve with your money is really important here. And then lastly is picking a time horizon. Is this something you need, you want to just flip it in a year? Personally, and I'll talk more about this later, our most successful property owner clients have extremely long time horizons for ownership. So, but you should get clear on this before you even buy the property. How long am I going to hold this property? Because when you're doing your financial modeling, this is going to drastically impact some of your return on investment calculations, specifically your IRR, your internal rate of return. And you should understand that the longer you own a property for, the more years your closing costs can be amortized over, which is just a fancy way of saying you get more for your money, right? The closing costs of real property are extremely high. And if you are churning out properties every year or two, those really start to eat you alive. So selecting and understanding all of these things first is really important for trying to find the property the perfect property for you. Okay. So the next step is to pick a location. And I really recommend you buy the most expensive property you can, which is like kind of a weird thing to say when it comes to real estate investing. But what I really mean by that is you definitely want to buy up. Like you want to own property in the nicest parts of town. And these are the reasons why. Nicer properties relative to lower end neighborhoods, obviously they have higher rent. Like everyone understands that part of it. But there's a few other nuances here that we see as property managers that really make the difference. And it's not just the rent. For one thing, nicer properties in nicer areas are able to command higher rents more consistently. There are periods of time when lower income properties and lower income neighborhoods can command higher rents, but it's more of a fluke. It can be seasonal, or it can be just really dependent on the economy. Whereas, nice suburban, great school district type single family homes are going to consistently have higher rents. Andrew, can you add an H in my name? We missed H on the last name there. I don't know if that was me or you.
You bet.
The other thing is you're going to have longer occupancies. So on average, in nicer areas, tenants just stay longer, and so they're getting settled into the school district and all this, and so the most expensive part of owning a rental property is your turnovers between tenants. And so over 10 years, if you can have, 2 or 3 turns instead of 4 or 5 turns, that is a massive difference in your out of pocket cost, and therefore your basically your return on investment for that property. Next thing is just better residents. I hate to say it, but people in these nicer parts of town, they're just like higher caliber renters. They pay rent more consistently. They cause less problems with neighbors. They're less likely to commit crimes. They're less likely to go to jail. They're just easier to deal with, and they're easier on your property, and it's just a better experience. And I hate that that's true, because it kind of gets tied up with like socioeconomic factors and everything. But that is the facts on the ground reality. Leasing is quicker. So when you do have a vacancy, nicer homes, they lease faster. And then the last thing is, I kind of touched on this, just less property damage from not only the renters themselves, but also vandals and just passersby. So when it comes to selecting an area where you want to own rentals and invest, go where the good school districts are. So my example here is, I'd rather own one nice single family home in a nice area than 4 in bad neighborhoods. The issue is that when you spreadsheet properties, like when you run numbers on stuff, these lower end areas, they can sometimes pencil really well. Like, it looks like on paper they're going to cash flow great and they're just going to be a fantastic return on investment, but your spreadsheet's wrong. And the spreadsheets and the estimates that you've made, and your assumptions around things like occupancy and repair costs and turn costs and so many other factors, they're just not accurate. And for various reasons, like, the accuracy of these spreadsheets and these rules of thumb is much better in these higher end neighborhoods. And like I said before, we've been doing this 12 years, and we've seen the trends, and we've seen the numbers, and our most successful clients, who consistently have the highest monthly cash flow and the most consistent, they own nicer properties in nicer areas, and they hold them for a long time. The folks who buy kind of junkier properties, they tend to cycle out of real estate investing because they're just not successful with it. Okay, so once you've narrowed in on your property type, your budget, and your location, you've gotten 90% of the way there. What you need to do now is actually find the property, and this could be a whole subcategory of webinars of like sourcing great rental properties. If I knew the answer that was easy and quick, and I could just quickly say it in 5 minutes as part of a webinar, I would be much richer because it's like finding these like, that's the game, right? That's the hard part. So I'm sure everyone knows to look on the internet, see what's available on Zillow, get hooked up with a great local realtor who lives in the city in which you're trying to invest, and work with that person to set up a search area and kind of your buy box is what they call it, and get them set up to notify you as properties come available. Occasionally stuff shows up on the MLS sooner, or just there's sometimes larger inventory available when you're working with a realtor than what you're going to see publicly on something like Zillow. Now, that's on market. There's a whole world of off-market deals, off-market properties. You've probably heard this buzzword 100 times. I am not an expert on that. We have never purchased a property off market. I know that you can get hooked up with wholesalers, get on their email lists, and they will send you properties that you can buy. You can go to local real estate investing meetup groups. They sometimes have off market deals. Or if you want to go direct, you can start, putting up these bandit signs and cold calling in your target neighborhood, your target property type. Again, I'm not an expert on these things, and sort of explaining how to do all that is a little bit beyond the scope of today's webinar. But my goal is just to give you what I think is the most important part, which is zeroing in on what you want to buy first, and then figuring out how can I get in touch with the people who own these specific types of properties. Questions before we move on to the next topic?
On the note of off-market properties, Peter, and we'll touch on this in 3 or 4 slides here, but we are partnered with a company who can help you get access to some of those off-market properties. So
Yeah, you're right. And you have a lot of experience from your prior role at RedX, kind of helping with this, right?
yeah, a little bit. So kind of like you said with the cold calling thing, a lot of real estate agents do this, but it's I think you could do it as an investor as well as calling either medium to high intent people like expired listings or for sale by owners, or even just cold calling entire geographic neighbors areas of a neighborhood and just basically asking them, hey, have you ever thought about selling your home? Do you want to do that soon? I'm ready to buy, and just kind of playing a numbers game there.
Yeah. The other thing, going back a couple slides here, um, if you are going to be buying property where you live and work, like in the same city, you need to tell everybody what you're trying to do. So again, getting back to that example of like, hey, I'm trying to buy a duplex in Grandview. If you tell that to everyone you meet, it's specific enough that um, it can trigger for them referral candidates and referral sources. Um, it's just another weird thing about like getting specific. If you just told everyone, hey, I'm trying to buy rental properties. Tell me if you know anyone. Like this goes in one ear and out the other. But if you say, hey, I'm trying to buy a duplex in Grandview, let me know if you see any duplexes in Grandview. There's something about that specificity that it sticks in their brain a little more. And so maybe they're at work and they overhear their coworker. I mean, there's 100 different ways it could happen by chance that they could somehow hear of a property meeting your criteria that is available or coming available. But that will never happen if you don't talk about it and if you're not specific with what you want. And so that's another reason to really narrow this down. But I've heard many stories, many, many, many stories of real estate investors finding some of their best deals ever through random ways like this. They just tell everyone they know, their banker friends, their colleagues, their coworkers, their family members, here's what I'm looking for. And they just randomly get a call. Hey, I heard, and it turns into some grand slam deal that they're still talking about 20 years later. So don't underestimate that. Okay. So let's talk numbers and deal criteria. The first thing is you need to have a pro forma, which is just an Excel or Google sheet that helps you analyze potential rental properties. There's 500 million examples of this on the internet. We can get you a copy of ours if you want. They're all very similar, but basically you put in the rent, you put in occupancy, and then you put in a bunch of assumptions about your expenses, and it spits out at the bottom, here's how much your ROI is, here's your monthly cash flow, here's your cash on cash return, here's your IRR. There's a little area where you fill in your financing. It's all very straightforward. This is like what I was talking about before, where when you buy in a low end area, the spreadsheets are wrong. It's because the assumptions that people make are just too optimistic. They assume occupancy is higher than it actually will be. They assume turn costs are lower and less frequent than they actually will be. They assume insurance is cheaper than it will be, and just all those things add up, and it ends up just they drastically overestimate their cash flow by many hundreds of dollars a month. And compounded over years, it ends up just not working out. So when you're filling out these pro formas, we can help with some of this at RL Property Management. If you've got a specific property in mind, we can run a market rent analysis, or what we call an MRA, for you, and you'll get back a really nice PDF, and it'll give our best expert opinion on how much we think that property is likely to rent for today. Now, things may be different if you close in 90 days, right? Because so just understand that it's, as of today, here's how much we think it could rent for. Um, and we can also, we suggest at approximately 92% for occupancy. So basically, your spreadsheet should be taking your monthly rent and multiplying it by 0.92, because over time, on average, that's how much rent you're actually going to be collecting. And then, like I said, monthly and annual expenses, and then your financing costs. You're also going to be plugging into the spreadsheet your down payment and your initial expenses, like we talked about. The good ones will have a way to make assumptions about those carrying costs, and then you're going to get these metrics out the back end. And so let me go back here. The metrics, the nice thing is, like, once you're consistently using these pro formas, you'll start to get a feel on how different properties show up, how the metrics look for different types of properties. And so you may want to set a minimum on your cash on cash or IRR. Some of this is going to relate back to what your goals for the property are, like we talked about in the beginning. Is this a cash flow play, or is this a long-term appreciation play? If it's a long-term appreciation play, you probably want to look at IRR. If it's a monthly cash flow play, you probably want to look on cash return. So again, this isn't like a real estate financial modeling course. Those exist. You can take them if you really want to get good at this. I just wanted to introduce you to this world a little bit. Couple quick things I see that are commonly missed here. Property taxes is a big one. Obviously, you can go on the auditor's website and pull up the current property taxes. But what will happen is, after you buy the property, immediately or shortly thereafter, the property will end up being reappraised for whatever you paid for the property. And then your property taxes will increase significantly in almost all cases. So you need to, in your pro forma, don't plug in the current property taxes, plug in the new property taxes, what they will be after the property is reappraised by the auditor at the purchase price. And they have a calculator on their website, I think, that will give you the actual number, given the new appraised price. The annual expenses, again, I don't have time to get into like a line by line, tutorial on how to forecast these. Whatever number you come up with, just go ahead and add 50%. That's the best advice I can give you without getting much more specific. And this is also highly correlated with the property age. If you are buying an older home, and by that I mean like older than 1990, I would say. So what is that? 35 years. You're going to have significant ongoing expenses related to the property's age. And especially if it's like 1940s or older, even more so. And then finally, if it's an HOA, don't forget about the monthly HOA dues. Again, here, what they are now is not what they're always going to be. 90% of HOAs, their monthly dues are too low. And I know real estate investors think the dues are too high, but they're actually too low because the cheap homeowners keep them low, artificially low, because they're cheap. And in the long run, the property ends up falling into disrepair because they haven't been collecting enough in monthly dues. If you want more about this, my business partner Adam Rich did a great whole webinar on HOAs that he went into great detail on this point. But just assume that they're going to go up, and when they do, you should be happy, not sad, because that means there's actually going to be money available to take care of the overall property and your investment. If it gets really bad, there may be like a special assessment where you have to write a check for $20,000 to make up a huge gap in the reserves because of years and years and years of underfunding because of cheap property owners.
I put a link to that HOA webinar replay in the chat there, in case anyone's interested.
I'm talking really fast. I don't see any questions. Everyone's just totally absorbing this. You guys are loving this. What do you think?
They're sticking around, so I think they're
Okay,
listening.
they're watching. They're there. All right, so Lineage, we've partnered with Lineage. If you're a current client of ours, you have access to their team and to their dashboard, especially if you have more than one property or if you're looking to grow your portfolio. Highly encourage you get in touch with these folks. I work very closely with the Lineage team on their product, and they have built these amazing dashboards where you can see your portfolio, and they have this off-market marketplace where you can look for rental properties that are in not only our local market but across the US, and they've got relationships with property managers across the US so that you can ensure your property is going to get linked up with a great property manager. So really can't speak highly enough about this team. It's made up of highly experienced real estate investors and property managers, and their whole goal is to help you be successful with real estate investing. And so their product reflects that. So you can scan that QR code if you want to learn more about how to get access to their off-market properties. Very relevant to today's topic. Please read the copy on the screen, and we will go to the next slide. Okay, how to negotiate. So it seemed like folks were pretty confident with this. We won't spend too long on it. The shortest way I can sum up all negotiation, whether it's salary, buying a house, getting a boat, whatever, is she who cares less wins. The person in the transaction who just cares less is going to have the leverage. So if you are a homeowner and you are moving to a new city for a job and you've got a family and you're under a time crunch and you have a limited budget, you are in a disadvantaged position because you care a lot about winning some specific home. That's the worst position you can be in. If you're a real estate investor and your goal is to buy one property this year and you have plenty of cash available and you're looking at dozens of properties a week, that is a fantastic place to be because you don't care about any one specific deal because there's always another one coming. That is going to be what you need to get a great deal, is being the person who cares less. Think about the person on the other side of that deal, the homeowner who's trying to sell, right? They only own one home and they're probably on some sort of a time crunch. They need to sell. They have no other choice. They can't just not sell in most cases. That person cares a lot about this deal. And so you should feel empowered to take advantage of that and get a great deal for yourself. So you may have purchased a home before. Real estate investing is not like that. It should be a totally non-emotional transaction. You should not get hung up on the view from the living room or some specific location or some specific landscaping feature. Doesn't matter. Tenants don't care. And so you shouldn't either. And just, you should just have this really detached, analytical way that you deal with the properties that you're looking at and the sellers that you're negotiating with. There's always another deal. That's the saying in real estate. If you overpay for a piece of junk property, that's the worst case scenario. And so no one ever went broke from not buying some property. People do go broke from buying a property that ends up being a horrible decision. And so it is painful. There's always that one that got away. I've got a couple of them. Every real estate investor you're ever going to run into has stories about the one that got away, the deal that they should have done. That's just chalk it up to a lesson. You paid for a lesson. You have to do that. That's all part of it. So don't beat yourself up about it. There's always another deal coming. I missed half a dozen great properties or more that we should have pulled the trigger on back in 2009 to 2012. Things have turned out okay for me. I'm doing fine. And so it's just, there's an education and an experience process that the only way you get it is by being in the game. It's being in the market and sending out offers and negotiating and walking away. And the more you do it, the more comfortable you get with it. If you're able to deal with a flat monthly or a slight loss in monthly cash flow, you're in a great position, especially with some of the tax advantages that have been reinstated with the recent omnibus spending bill that was passed by Congress. If you do a cost segregation study, there's huge tax advantages that are available, especially if you're a real estate professional. I think I got a bullet point about that later. But what I'm trying to get at is like, it's okay if your property isn't cash flowing every single month. In 10, 15, 20 years, you are going to be so happy with yourself that you bought that property and held on to it. So happy. I mean, even like that property we bought in 2008, how many years ago was that now? 17 years or something like that. I look at the mortgage, balance and the mortgage payment, and it's like, it's a joke. But at the time, it was like, we were so concerned about how much we paid for it and everything. And it's like, because it's in a nicer area, just time is on your side when it comes to real estate investing. So highly encourage buying nice properties in great areas and holding them for a very, very long period of time. That is what the most successful real estate investors do. They say with real estate investing that it's not, you don't try and time the market, it's time in the market, I think is the way the expression goes. Okay, a little bit more on negotiating. This is just something I've noticed. If a seller is like responding really quickly and sort of trying to meet you in the middle, that means you got it. You got them. Like they're absolutely desperate to sell and they will make a deal with you. And you should push that advantage and really negotiate hard at that point. The sellers who just kind of ignore you or they don't even counter offer, they just tell you like, what's your best offer? Like you send an offer and they're like, that doesn't work, give us a better offer. Like they don't even counter. Those are the people who don't, they're like, they for some reason, they're like not caring and that gives them strength. But the first example here, which is pretty common, those are people that care. And so you can get a really good deal in those situations. The reason I bring this up is because I see people, they're afraid to push. And I want to encourage you that you can push. You can push for a great deal. You're not going to like scare someone away or something. If they say no, then you can offer more. You can offer again. But if you are able to hold out a very firm, very aggressive posture during a negotiation, you will sometimes be amazed at the deal that you can get, better than you thought you could. Don't skip property inspections. Don't ever do that. If you skip a property inspection, you are cursed for life. Horrible things will happen to you. It's just it's bad. The risk reward trade off there is unbelievable. You're saving $400 and you're risking $400,000. There's no gambler in the world who would take those odds. If you can buy with cash, this is a great way to give yourself a leg up in a negotiation and give yourself an advantage over other buyers. Now, this doesn't necessarily mean that you need to own the property in cash forever, but if you have access to like short-term capital, short-term loans, then you can buy in cash and then finance. And it is so much easier if you can do it this way. I know it's not possible for everyone and it can be really hard to do, but some options here is like if you have a bunch of equity built up in either your personal residence or some of your other properties, you can get a home equity line of credit and use that. That's a perfect way to use home equity line of credit funds is for something like this. I actually did this when I bought my personal residence, when I kind of upgraded my personal residence. I used cash from the home equity line of credit on my existing residence. Now, I didn't pay in cash, but it did help me with the down payment. You can also get really, really awesome loans against your equity portfolio. So if you own a bunch of stocks, even if they're in like retirement accounts and stuff, you'd be surprised. Call up your servicer or your brokerage and talk to them about this, and you may free up significant capital.
Peter, we've
Again, I
got a
don't
quote.
just real quick, I don't recommend that you use either of those options in a permanent way. Don't recommend buying real estate and using these things permanently. It's more of a stopgap until you finance the new property. And the reason I used a HELOC is because I was selling my old house, but I wasn't going to do that till after I bought the new one. So I used cash, helped with the down payment on the new house, moved in, took my time listing and selling the old house, and then, of course, paid off the home equity line of credit with the sale proceeds.
We got a question there in the chat from Erez. Is there an optimal time to hold the rental investment property?
As long as possible. I think I have a slide in here about that, so we'll return to that. It's a good question. All right, a little bit more on financing. So if you have a high W-2 income, that's the easy button. And you're going to find financing very straightforward, especially for 1 to 4 unit properties. You can have up to 10 loans through conventional financing, Fannie and Freddie. That's kind of the middle of the road, easy button, best rate, lowest down payment. That's not always the case, though. Like after I quit my engineering job and started RL Property Management, it became much harder to buy rental properties because I no longer had that high W-2 income. Because it was a newer company and I was an owner, they considered it self-employed, even though I did have a W-2. You can still do it though. Talk to a bunch of banks and lenders, see what their requirements are, talk to them about being self-employed, get a feel for their appetite in the specific property type and location. Different banks and different lenders, and it changes all the time. Sometimes they're really hungry for these types of investor loans, and sometimes they're not. And it changes. So if you are trying to get financing done on a deal type or property type or even location, a lot of this is location driven. If the bank doesn't have the appetite for it, they throw up so many roadblocks and hurdles. If they do want more duplexes in Grandview on their balance sheet for whatever reason, they will be very straightforward and make it easy for you. So don't swim upstream. Talk to these guys ahead of time and get them to be very clear with you. Like continue to ask them obnoxious questions until you feel like you have an understanding of this. Because what happens when you first walk in, I know you guys know this, like when you first start talking to some dopey mortgage lender person or whatever, the answer to everything is yes. Oh yeah, we do tons of those. Yeah, we love to help work with you on this. Just, click here to start the application, right? That's what they want you to do. You got to just ignore all that. You got to push through that and really get them to get real with you and be like, okay, how many of these deals have you done in the last year? And where are most of your loans happening right now? And what type of property types are, there's like different, like there's Community Reinvestment Act that says that they have to have so many loans in different parts of the city and where they operate and stuff. So there's a lot of nuance here. Again, this is a whole subcategory that's a little beyond the scope of today's overview. You can learn a lot by going to like local real estate investor meetup groups. They love to have these bankers and mortgage lenders come and talk, and they'll usually be very transparent and straightforward with you in that context compared to just like walking into the bank or calling up and trying to talk to somebody. All right, a little bit more here. If you don't have a high W-2 income, or if you're self-employed, there's a different type of lender they sometimes call these DSCR loans. Lending One is an example. They've sponsored my newsletter before. They don't care at all about your income. They just look at the property. And this is especially relevant for 2+ unit properties. This can be really advantageous. Now, the interest rates aren't quite as good, but if it's the difference between getting into a property and not getting into a property, it can still work out really well. So that's a great option that you should know about. You should also know about hard money lenders. You'll see these guys hanging around all the local real estate investing meetup groups. They like to do fix and flip type properties, but they can also do like buy and holds, because if you're gonna buy something, fix it up, then refinance it, and then you'll cash out the hard money lender. A lot of these guys are just people who have been around real estate for a long time, real estate investors who've been doing it a long time, and they lend out their own money, and they've constantly have money coming and going for these different loans. High interest rates, very high. One of the best options can be friends and family. Private money is the fancy word for it, but it's basically just, your mom gives you a little money to help you buy a rental property or whatever. Your rich uncle is the classic. So that's great. I mean, that's awesome. If you can work that out, it's a great way to go. Pay them a fair interest rate, and they're not likely to foreclose on you. If you need a little flexibility, they can probably do that, but don't take advantage. Treat these folks well, get them paid back, and then they're going to be all the more willing to work with you to do the next deal. So that's a great way to go. Quick note, because I've seen this a lot. If you start looking for a rental property and you talk to a bank and you get pre-approved, don't do anything with your credit, okay? Don't go buy a car, don't refinance another property, and don't quit your job. Believe it or not, you see these TikToks with mortgage brokers who they're all clear to close. They're ready to, help their client buy a property. And it's like, oh yeah, I quit my job. You're like, what? Yeah, we're going to be doing real estate full time. So I just, I gave my 2 weeks. But the lenders will do, like, the day of closing or the day before, they pull your credit again, and they will often re-verify employment. And if you do not have as good or better credit and are not employed where you were, they will not close. So I know that sounds really stupid and obvious, but if it saves even one person from doing this by accident, it will have been worth it. All right, let's go to poll 2, Andrew. What's the biggest red flag when buying a rental property?
You can choose more than one of these too as you go through.
I think we've seen all of these and more in professional property management.
Mm-hmm.
All right, let's take another 10 seconds. Get your votes in. Multiple options if you want. All right, let's see results. Okay, number 1, major repairs. Yep, that's a big one. Number 2 is tied for high vacancy, sketchy seller, missing documents, and then number 3 is rent won't cover the mortgage and reserves. Yeah, definitely hidden major repairs, and that's why I was talking about the importance of an inspection. The inspector, a good inspector, is going to be able to uncover things that you just can't, as a layperson, you wouldn't see or wouldn't know to look for. It's great. All right. I think this is the last one. When to walk away and when to pounce. So you're in negotiation and property type, you like it, area's good, you think you've got a financing solution, you are close with the seller, but you're not there yet. What do you do? So a couple things to think about here. Don't get stuck in analysis paralysis. I see a lot of the types of people who are attracted to real estate investing. They tend to be analytical in nature, and it's easy for them to get stuck and not pull the trigger year after year after year. Right? They find this deal, they don't go through. They find that deal, they find a reason. Like, you can find a reason to not do any deal, every deal. If I think back of all the properties we've purchased, and there was great reasons for all of them to not have done the deal. You could find one for every deal, and it's just a little bit of discretion and wisdom and understanding which of those are so bad that you should walk away versus what's just something that, yeah, that's a problem. We're just going to deal with it. We'll figure it out, right? So some things to think about as you're on the fence here is real estate is extremely tax advantaged. It's a great place to park money and watch it grow. It's not so much a get rich quick type of activity. If you want to start generating high cash flows, you're better off starting a landscaping company or something. It's just cash flow from real estate is small. I mean, any individual unit, if you're cash flowing a few $100 a month positive after like truly accounting for your capex and reserves and everything else, you're doing pretty well. So it takes a lot of units to really start to see massive income. It's not like an income generating activity. It's more of a what you do with your income after you've paid your bills. That's like what you do with real estate. So keep that in mind as you're trying to decide whether or not to do a deal or not. And you should also understand that financial advisors really are biased against real estate investing, mostly because they can't charge a fee on it. They can charge a fee on your IRA and your 401k and your brokerage account and all these different mutual funds and everything. They make fees 6 different ways on those accounts. They don't see a dollar if you invest in a duplex. Now, the good ones are more open to real estate investing, but the problem is they don't understand it very well because it's not covered in any of their training or education. And so you're just not going to get great advice from a financial advisor when it comes to real estate investing. Something to think about too is that there's a lot of risk in owning rental properties. And I've listed some of the risks here. If you've owned rental property for any length of time, you've run into one or more of these. And so you need to be comfortable with these risks if you're going to own rental properties. And you should think about these specific risks as it relates to the property that you're sort of trying to understand whether you want to buy or not. So here's my overall advice on whether to walk away or whether to pounce. If you have the cash to invest and you haven't like tapped out retirement accounts or something, you've run the numbers conservatively and you're comfortable with some risk and you like the property in the neighborhood, I think you should go for it. Overpaying by a couple $1,000s is not the risk here. The risks are much more about wrong property type, wrong neighborhood, over leverage. Like there's larger, more systemic risks rather than necessarily like overpaying a little bit for one specific property. Now, overpaying by $10,000 or $20,000, that can make a difference. But if you've been on the fence for 2 years, you finally found a deal and you guys are like $2,000 apart, just buy the property. You're going to be, chalk it up to the cost of education of getting that experience for your first deal. Okay, yeah, I actually listed these out. So, okay. Overpaying by $2,000 is not going to make or break the investment. Here's what will ruin you financially. Buying bad areas, buying junky flipped properties, letting properties sit vacant while you come up with money to get the unit ready to rent. I see that a lot, especially once you have multiple properties. Transacting too frequently. The longer you hold property, the better for like 12 different reasons. So Erez had asked that, like the optimal time to hold the rental/investment property. If you do some financial modeling, there can be situations where it is financially ideal to like trade properties after X years. Some of this has to do with depreciation schedules. Some of this has to do with return on invested capital. That's a rounding error when it comes to the human nature factor. By that, I mean, most people are not running those fine-grained financial analyses when they decide whether to sell a property. Instead, they just say, oh, this was a really expensive turn. I think I better sell. That is not the right way to do that. In the absence of fine-tuned analysis suggesting otherwise, the best thing I can tell you to do is to hold property indefinitely. And then the last thing here is not having the right mindset. If you have the wrong mindset around the investment or real estate investing in general, that is far more dangerous than overpaying a little bit for a property. And we've talked about mindset throughout this hour, from understanding the risks to getting specific with what you want to own to holding it long term through the ups and downs. All right. I felt like that was a lot. I hope that was packed with useful information and context. I've been a real estate investor since 2008 and managed property professionally. So I feel like I've seen a lot, heard a lot, dealt with a lot of different properties and deals and investors and sellers, and tried to condense as much of that down into like bite-sized chunks that I could cover in 1 hour for you.
We had one question come in also from Merez. What is the current real estate market looking like in Columbus with an emphasis on the rental market, specifically about the Intel delay to 2030? Will that have implications, in your opinion?
So I don't have great answers for this. I would probably defer to a realtor to speak to this more specifically. We are so focused on managing our customers' properties here that we are just not as tuned into the ups and downs of the market and the latest news from Intel as a realtor would be. So I'm going to give you an I don't know. And I know we have a realtor here today, and then we also have realtors that we can introduce you to as well.
Awesome. Sounds like I need to do another updated market update to send out.
Oh yeah, Andrew, that's I forgot we did that. So
Yeah,
Erez would benefit from that, especially if you update it.
excellent.
Thomas asks, would you buy a B plus single family rental in an A plus neighborhood, or an A plus fourplex in a B plus neighborhood? Interesting question. I would probably buy the fourplex because a B plus neighborhood, I like those neighborhoods a lot. A plus neighborhoods like can have their own unique challenges. Typically, the purchase price is so eye-wateringly high in an A plus neighborhood that the numbers just don't pencil. B plus neighborhoods, we love those. Those are our bread and butter. An A plus fourplex and a B plus neighborhood, man, that's what you want to own. That is a beautiful thing. So I would buy those all day long. All right, we have another question. What if you had a property that is worth $750,000 now and is fully paid off and rents for around $3,200? Would you hold it or sell? Very interesting question. It's a great place to be. Let's see. What I would have to do there is I would have to talk to a couple bankers and mortgage folks first, because what I would want to do first is understand what it would look like to do a cash out to finance that property. I'm going to call it a refi, but that usually implies that there's existing financing. But basically, a cash out refi. So basically, you would finance, if it's worth $750,000, they'll probably let you pull out 70% of that value in cash. So that would be 500K, a little over. So then you could take that 500K and reinvest it into another property. You could use that either buy in cash or use that as a down payment or buy two properties. So you would want to model that out and see how those properties would cash flow and see, if it rents for around 3,200 and you do a cash out refinance, what would be the mortgage payment on that? And my guess is it would be more than $3,200. So, you could look at financing less, like maybe only taking out, $200,000 instead of $500,000, and see how the numbers look there. So that's a really interesting exercise. I would definitely want to put pencil to paper and model that out a few different ways to understand what would be the financially optimal, move to make there. I would also want to get a really good understanding of your mindset and your risk appetite. That would play a big part in my recommendation. All right, we are at time. I appreciate everyone jumping onto our webinar today. I hope this was really helpful. Next month, what are we talking about, Andrew?
Next month, and I am putting a link to register in the chat right now. We are talking about the pros and cons of different rental types. So we're going to kind of go through the key differences of like single family, multifamily, commercial, even like campus and Section 8 type properties. Talk about typical returns, talk about lease types, how those impact your cash flow and control, and then different factors to watch for with all those ultimately to determine like what property type is right for you in your investment strategy. So.
Beautiful. Can't wait. We'll see everybody then. Thanks for joining us today.
Thanks, everyone. See you, Peter.
See ya.